On January 1st, the world's markets were supposed to be sleepy, but a strange ripple moved from Shanghai to London to New York, like someone yanked a cable under the ocean. Silver jumped, funding markets twitched, and one headline made traders squint and whisper, "Something doesn't add up." Because here's the puzzle: silver is a small market compared to stocks or oil, yet it can expose stress in the big system fast. When silver suddenly behaves like a smoke alarm, you don't ignore it just because the kitchen looks clean. Today I'm going to walk you through what people are calling the silver shock, why China is being blamed as the trigger, and why banks allegedly scrambled to borrow about $17 billion just to stay comfortable. And no, this isn't about magic or conspiracy, it's about plumbing. By the end, you'll understand the chain reaction in plain English, how a move in metal can squeeze liquidity, why collateral matters more than opinions, and what signals to watch before the crowd notices. I'll also share the skeptical take, because you should hear it, and then I'll explain why it still might not be the full story. Most importantly, you'll know what this means for regular people who don't trade futures for breakfast. Because when the system gets tight, it shows up later in borrowing costs, business decisions, and yes, your everyday prices. Start with a simple idea. Silver isn't just a shiny coin metal, it's an industrial material with a financial tail. It's used in solar panels, electronics, medical tech, and a bunch of things you touch without realizing, so demand doesn't always behave like a luxury good. Now layer in the financial side. Silver is also collateral, a hedge, and a pressure valve for risk sentiment. When confidence wobbles, money looks for places where supply is real and inventories are visible, and that's where silver gets loud. So why China triggers this? Because when China changes how it buys, stores, exports, or settles commodities, it can shift the balance even if Western headlines don't lead with it. Think of China as a giant hand on the scale, because it wants to break the scale, but because it's big enough that tiny movements matter. And January 1st is a perfect time for weirdness, because balance sheets reset, quotas refresh, and institutions start the year with new rules and new constraints. That timing is not proof of anything, but it's the kind of coincidence markets respect. Here's the first clue people point to: sudden tightness in physical silver availability relative to paper claims. If more buyers ask for bars instead of promises, the market has to prove it can deliver, and that's when spreads, premiums, and lease rates start talking. If you've never heard of a lease rate, don't worry, just picture this. If it gets more expensive to borrow silver, it means real metal is harder to find at the usual price. When the cost of borrowing a thing jumps, the thing is telling you it's scarce, or at least treated that way. Now connect that to banks and the $17 billion borrowing figure. Banks borrow short-term money every day like breathing, but when they suddenly borrow more than expected, or at higher rates, it can mean the room got colder and everyone reached for a jacket at once. This is where the plumbing analogy matters. The financial system is like a city's water system, and liquidity is water pressure. You can have plenty of water in the reservoir, but if a valve sticks or a pipe narrows, pressure drops at the tap. When that happens, banks don't panic on TV. They quietly borrow more in overnight markets, repo facilities, or interbank lines. It's not always a crisis, but it is always information. So how does silver connect to funding pressure? Because in stressed moments, the best collateral gets hoarded, and anything questionable gets discounted. If silver moves sharply and collateral preferences shift at the same time, it can signal that institutions are repricing what they trust. Imagine two neighbors during a storm. One has flashlights and batteries, the other has a promise to buy batteries later. When the lights flicker, which neighbor feels safer, and which one suddenly needs a loan? One reason China gets mentioned is because it can increase industrial demand quickly or change import patterns that drain available supply elsewhere. If a chunk of physical silver gets pulled into long-term use or locked into reserves, the float shrinks, and paper markets feel it. Another reason is settlement behavior. If more trade gets settled in ways that reduce reliance on certain funding channels, it can reshuffle where dollars and collateral are needed. And yes, that can make some banks scramble for short-term cash. Here's a line worth remembering: the market doesn't run on opinions, it runs on settlement. When cash has to arrive by morning, narratives don't count as payment. Now, I'm going to pause on the $17 billion number for a second, because numbers can mislead if you don't frame them. $17 billion is huge for a person, but for global banks, it can be a routine spike during quarter starts, regulatory windows, or holiday-thin liquidity. That's the skeptical viewpoint, and it deserves respect. The bear case says this is normal seasonal funding demand, plus a silver price pop that looks dramatic on a chart, but is actually small in macro terms. The bear case also says silver is volatile, headlines chase it, and people love a storyline that connects China, banks, and a shiny metal. In that view, this is just noise, not signal. Now, let me tell you why that might be too dismissive. Markets can look normal up until they're not, and the early warnings are often boring metrics that spike quietly while everyone argues about the story. If you see multiple small anomalies at once, that's different from one weird data point. Silver tightness, higher borrowing needs, shifting collateral preferences, and sudden changes in spreads can form a pattern, and patterns are what risk managers actually trade. Here's another quotable line: when liquidity gets tight, the truth gets expensive. You don't notice it first in headlines, you notice it in funding costs. And that brings us back to January 1st. New Year positioning can force banks and funds to rebalance, and if too many players reach for the same safety at the same time, the cost of safety rises. Picture a movie scene where everyone tries to leave the theater through the same door. There's nothing wrong with the building, but the crowd creates the problem, and the door becomes the story. Now toss in silver's weird dual identity. It's industrial like copper, but it trades emotionally like gold. So it can jump when factories need it and also jump when fear needs it. If you're enjoying this breakdown, tap like, subscribe, and turn on notifications, because I'm tracking these plumbing signals all year and updating when the data changes. This stuff moves fast, and the first clean explanation is usually the most valuable. Let's talk about what a silver shock actually looks like in practice. It's not just price going up. It's price going up while the cost to source real metal rises and paper markets start acting jumpy. In calm times, paper and physical stay close, like two runners tied together. In stress, the rope stretches, and you can tell which runner is tired by who starts lagging. Some traders watch inventory reports, delivery notices, and the premium on certain bar sizes in key hubs. When those premiums rise while futures stay normal, it can mean the market is suppressing a problem temporarily. And that's an important word, temporarily. A lot of finance is just time shifting, borrowing calm from the future to look stable today. So where does China come back in? Think about industrial policy and scale. If solar manufacturing ramps or if stockpiling happens even modestly, it can eat a meaningful slice of available supply. Silver is not oil. It doesn't have the same giant buffer. Now, I'm not saying China is doing anything sinister here. I'm saying when a giant buyer changes pace, everyone else feels it, and the system sometimes labels that feeling as a trigger. Here's a third quotable line: small markets reveal big stress. Silver is small enough to move, but important enough to matter. Also, silver is one of those markets where leverage can be high relative to physical backing. When leverage meets a physical squeeze, you get sudden, sharper pricing that feels like a trapdoor. If that happens near a time when banks are already managing balance sheets tightly, it can amplify the need for short-term borrowing. It's like trying to refinance your house on the same day the bank's computers go down. Now, I want to ask you something, and I really want you to answer in the comments. Do you think this silver move is a one-week pop that fades, or the start of a multi-month repricing that surprises people? Let's zoom out to consequences, because that's what matters. If banks have to borrow more to survive a tight window, even if it's temporary, it signals that comfort is not free right now. When comfort gets expensive, banks become picky. They lend less freely, they price risk higher, and businesses feel it in credit lines, inventory financing, and expansion decisions. And if businesses slow, that affects jobs and wages and consumer confidence, which then loops back into markets. That's why watching a weird silver spike isn't niche. It's like noticing the first tremor before a bigger shake. Now, To keep this grounded, we should admit another possibility. This could be a controlled stress test in disguise, the system flexing but not breaking. Sometimes the plumbing squeaks, the maintenance crew shows up, and the water keeps running. But even a squeak tells you where the weak joint is. And if you're paying attention, you don't need a flood to learn where the risk lives. Let's do a quick reality check with the simple analogy. If a store suddenly borrows cash to restock one specific item, it might mean that item is flying off the shelves, or it might mean suppliers are demanding cash upfront. Either way, something changed in the relationship between trust and delivery. And in markets, trust and delivery are everything. This is where the bull case gets stronger. If physical silver demand is genuinely tightening supply while funding markets show stress, silver could reprice not as a trade, but as a signal asset, reflecting real-world constraints. The bull case also says silver is undervalued relative to its industrial role in electrification and solar growth, especially if inventories are thinner than people assume. If supply can't ramp quickly, price becomes the rationing tool. But let's be careful, none of that is a guaranteed outcome. Silver can whip around, shake out both bulls and bears, and still end up doing nothing for months. So what should you watch next? Without staring at charts all day, watch for repeated spikes in short-term borrowing needs, widening spreads between physical and paper, and any sign that delivery stress is becoming routine instead of rare. Also watch how quickly the story changes. When narratives flip from nothing to see to urgent, it often means the move already happened and the crowd is late. Here's a fourth quotable line. The headline is the echo, not the sound. The sound is in the data first. And don't ignore the human behavior layer. When traders and institutions get surprised, they reduce risk everywhere, not just in the one asset that surprised them. That's how a silver shock can bleed into equities, credit, or currencies, even if the original move started in a niche corner. It's not the size of the corner, it's how leveraged and connected it is. Now, let me give you a practical takeaway you can actually use. Instead of trying to predict the next dollar move in silver, treat this as a stress indicator. Is the system getting looser or tighter week by week? If it's getting tighter, be cautious with leverage, be picky with risk, and keep more flexibility than you think you need. Flexibility is an asset when everyone else is forced to act. And I want a second comment from you, because this reveals how people see the next year. If you had to choose one, would you rather hold more cash for flexibility or more hard assets for protection? And why? Here's the part that makes this feel personal, even if you never touch silver. When banks borrow more just to stay stable, it hints that stability is being managed, not assumed. Managed stability isn't bad, but it means you should pay attention to the managers. If the same tools get used more often, the system becomes more sensitive to surprises. That's why I'm watching January 1st like a marker in the sand. Not because it proves everything, but because it might be the first visible crack in the story we've been told about smooth markets. If the bear case is right, this calms down, funding normalizes, and silver drifts back into its usual chaos. If the bull case is right, this is the opening act, and the next act shows up in delivery data and credit pricing. Either way, you now know what to look for, and you won't need a loud headline to tell you something changed. You'll recognize the signs in the plumbing. So here's the payoff. The silver shock isn't about a shiny metal, it's about stress transmission. And China's role is less villain and more gravitational force. When a giant shifts, the smaller pieces rearrange, and banks often reveal it first through borrowing. Take this into the next week. Watch funding conditions, watch physical premiums, and watch how quickly institutions move from confident to cautious. In the next update, I'll show you the single chart and metric combo that most people ignore until it's too late, and why it could confirm whether this January 1st shock was a blip or a turning point.